Hello, I'm Sam Stovall, U.S. equity strategist for S&P Capital IQ. In this week's Sector Watch, I discussed how the broader market was essentially unfazed by last week's macro events, but saw a lot of subsurface turmoil. The U.S. equity market held up exceptionally well last week as the S&P Composite 1500 closed essentially flat. On a sub-industry level, however, the magnitude of subsurface turmoil was eye-opening as 70% of all 150 sub-industries saw advances or declines of 1% or more, and 34% rose or fell by 2% or more. And the dominance of this volatility was to the downside. We don't see the events of last week throwing the U.S. economy into recession, so we remind investors that during periods of seasonal softness, it's typically better to rotate than retreat. As a result, S&P Capital IQ made 4 sector changes in the past week. We lowered energy to underweight from market weight, reduced industrials and tech to market weight from overweight, and raised telecom services to overweight from underweight. So there you have it. S&P Capital IQ forecasts the S&P 500 to rise to 2250 by mid-2016, implying a 9% price appreciation based on an improving U.S. economy, a 13.4% growth in aggregate operating earnings per share expectations from the second quarter of this year through the second quarter of next year, and inflation that remains relatively tame at or below 2%. Accompanying this above-average price appreciation will be elevated volatility from ongoing macro concerns and the impact from the start of the Fed's recalibration efforts. We continue to recommend a neutral exposure to equities, but suggest investors focus more on underlying stars recommendations in this defensive growth environment. I'm Sam Stovall, and I'll talk with you again next week.